My name is Jason Ayres. I am a derivatives market specialist by designation, an instructor with the Montreal Exchange, and Chief Executive Officer at the Croft Financial Group. As mentioned, we're going to be talking about options today, but we're going to be more specifically looking at how we can use technical analysis to determine an entry point into the market. One of the biggest challenges that investors run into is, okay, I understand the different strategies available to me. I understand what types of stocks that I want to participate in as far as, an investment or taking a position. How do I actually figure out a way then to take action? And so technical analysis is actually one way that you can use to help make those decisions. Now, as always, we just want to remind everybody, of course, that the information presented here during today's presentation is for educational purposes only. The options market, not unlike all financial securities markets, does carry with it some risks. And while some of the strategies we're going to look at today, do have a limited risk exposure associated with their risk profile, there still is nonetheless risk involved, and we just want to make sure that you guys understand that before going ahead and clicking the trade button within your live trading account. So what we're going to be talking about here this afternoon is, first of all, just taking a look at the difference between technical analysis and fundamental analysis, with a more specific focus on technical analysis, which is essentially analyzing price charts over various time frames and using different techniques in order to help identify specific entry and exit points, to help you, again, make better, more effective trading decisions. We'll look at taking a position. So we'll give you an example as to how you might tie together something that you're seeing within a price chart with an option strategy that might make sense to utilize as a stock replacement strategy to participate. And then finally, we'll wrap things up with a few important considerations that we can leave you with at the end of the presentation. All right, so technical analysis and fundamental analysis. Well, technical analysis is review of market developments primarily through graphs. So basically what it is that we're looking at is we're looking at on a day-to-day or week-to-week basis the price action of a particular security. And what we're trying to do is we're trying to identify patterns or trends that will help us more effectively make or take a directional bias or make some sort of a decision to help us manage a position more effectively. Based on the behavior of the price chart. The idea behind technical analysis really stems from an old saying that price action discounts everything. So what that means is it really doesn't matter what you think. It doesn't matter what I think. It really, at the end of the day, doesn't matter what the analysts think. It's really what is that price action doing? And that ultimately is, what the market is prepared to pay on a per share basis for the, for participating in the opportunity. Now, quite often, technical analysis is used for short-term trading. It doesn't necessarily have to be. You can apply technical analysis to longer time frames to help you get a better perspective as to how a stock has been trending over a period of months or even years. And quite often we'll look at, the primary trend that's in place, which would be a focus on, long-term trend analysis. And then all the way down to, the short-term trend that's in place, which would help us take positions that would ultimately go along with that longer-term trend that's been in place. So again, technical analysis, reading of price charts, the idea that the price action really is, dictates everything, and we want to make sure that we're on the right side of it. Now, on the other side of it, and what you'll hear quite often, is the application of fundamental analysis. And that's really a review of financial statements and all sorts of other economic variables that would help somebody really assess the value of a business. So the underlying business associated with the, with the company that you're looking at to determine whether or not, it's trading at fair value, undervalue, What sort of expectations might we be looking at as far as their company CFO's forward guidance, all that sort of stuff, which really at the end of the day tends to be quite boring, but analysts spend hours and hours and hours pouring through, and I can tell you this from experience, in trying to help assess whether or not a business is a good business to invest in. And so the idea here is that, when you're looking at it from a longer term perspective, as an investor, you always want to make sure that, you're investing in a good company. So that's where sometimes you'll see the different applications, from fundamental analysis to technical analysis. Technical analysis is really about trying to capture price swings. Fundamental analysis is really about trying to determine whether or not the underlying business or the underlying sector that you're looking to invest in is really worth investing in. Or on the other side of it, we know we can take the opposite side of the market as well. Is it overvalued? Is there an opportunity to short the shares of the security because the market is way beyond trading, way beyond expectations associated with the fundamental analysis? Now, I, for one, have learned that there is value in both. But at the end of the day, we make money on price action. So we want to really try to find strategies and techniques that, while we may be doing an analysis on the underlying company or the underlying sector itself, we then want to take it one step further to use technical analysis to help trigger an entry point. So we like a company, it looks great, underlying fundamentals are rock solid, but we're not going to make money on that information until the price action starts to show us that people are also interested in buying or bidding up the share price. So that's where the technical analysis comes into play. All right, so technical analysis and options. Options tend to be utilized for short-term opportunities, whether it's to trade a directional bias, whereby you're buying a call or you're buying a put as a stock replacement strategy rather than shorting or going long the stock, or whether you're looking to sell options as a mechanism for generating cash flow, which are strategies that you've heard us talk about in various presentations. Options tend to lend itself, or technical analysis tends to lend itself very well to option trading, because we can look at the short-term observations within the price chart, and we can use that to help us determine a time frame for a strategy, or even what type of strategy, option strategy, might be the most appropriate to utilize. On the other side of it, and as I mentioned earlier on there in the last slide, when we're looking at bigger picture long-term opportunities where we want to sort of buy and hold positions, fundamental analysis really comes into play. But I'll tell you, the interesting consideration here is you could have a company that you really feel is a rock-solid business. You think it's a fantastic investment. You're in it for the long haul. And then you turn to the technical charts and you say, okay, how can I use my technical analysis to show me where a covered call strategy might be most appropriate, or where it might make sense to integrate a protective put to protect my longer term investment, right? So you can marry the two very effectively to help make better investment decisions. All right, so let's dig into some of the general principles of technical analysis. Well, first of all, the idea is that the market anticipates all news. In other words, what we mean by that is that all known information is already priced in to the stock. So, this is where you hear about companies trading at, X times multiples, or X times earnings. It's because investors are already pricing in that information out into the long-term projection of the share price. And where you'll see, and you'll probably notice this from time to time, if you ever see a stock, after an earnings report where, it's at one price the night before and then it gaps down significantly or it gaps up significantly, after the news, well, that's basically the market saying, well, we didn't price that in. And subsequently you get that big gap in price action, either to the upside or the downside. So we want to recognize that based on the level of information that's available today, not just to investment professionals, but also obviously to, retail investors, that, the market is already anticipating the information. Prices fluctuate based on trends. So we know that the market does not go up or down in a straight line. There's always going to be little waves, little ebbs and flows, little peaks and valleys that indicate certain periods within the, within the trading history of a stock or a commodity or what have you, where, market conditions have changed, investors have changed their sentiment, and at the end of it all, they've ultimately either bought more aggressively or sold more aggressively based on that information. Now, the final principle is really that history is doomed to repeat itself. In other words, people have not changed forever. Fear and greed is always two primary driving forces within the market. And so technical analysis is really about identifying specific patterns, specific, price behaviors within the day-to-day or week-to-week price action of a particular stock, and identifying those patterns that have manifested themselves historically that have led to specific price moves, ultimately having a high probability in doing so again. And I use the word probability, and this is something that everybody needs to really pay close attention to. If we all had a crystal ball, or if I had a crystal ball, this business would be easy. At the end of it all, what we're really focused on is trying to identify certain things taking place within these price patterns that are going to give us a higher probability of being correct. So in other words, if we notice a support level, which we're going to talk about, or a resistance level, or a particular price pattern, or a particular signal within an underlying indicator that has historically led towards a specific move, then we can say with some confidence, it's happened like this in the past, so I'm going to use this signal as a mechanism for making a decision to participate in the likelihood of it happening again. And so this is what we're doing with technical analysis. All right. So, as I mentioned, the market anticipates all the news. And, we can see this on a day-to-day business now, and particularly this year with respect to the headlines associated with this global pandemic that we're dealing with presently, or even the U.S. elections, for example, that we're dealing with, whereby as soon as you see a specific headline come across, the market is always already moving in one direction or another because of it. And, here we've got those sort of price actions indicated, by a happy face, and a sad face. But what I'll remind everybody is that your emotions are going to be a function of what side of the trade you're on. So if I had shorted the market just before it sold off based on some technical observations, when it hit a lower low, that'd be a happy face. That the happy and sad face is really only a function of being on the wrong side or the right side of the trade. So keep that in mind as well. And again, the opportunity with the options market is that you can really effectively play both sides of it based on your expectations of the underlying stock, whether or not it's based on fundamentals or technicals or a combination of the two. All right. So the other consideration is that, really all that we're looking for in a price chart at the end of the day is trying to identify a specific trend that is in place or that is about to come to an end so that we can make a better decision. Now, we're trying to assess what the probabilities are in terms of just the continuation of a trend. And ultimately, what we're doing is we're just looking to take advantage of a position by following the trend. And as I said, you can use these observations to take action on a new opportunity. So we're going to show some examples around that. Or you can use these observations to help manage an existing opportunity. So all you're looking to do is identify, okay, is this the start of a trend or the end of a trend? And what do I need to do to take action to manage the probability of that indeed being the case. So again, I talked about the idea that history is doomed to repeat itself. Again, this goes back hundreds, thousands of years. Even when we look at technical analysis, and more specifically the idea of candlestick analysis, which is the example that you're seeing here in the chart, that actually dates back to ancient Japan, when they used to use this kind of analysis to track rice charts and other commodities in terms of just being able to follow trends. So what we're talking about here, although technology has really changed the accessibility, for us in being able to utilize technical analysis, this approach has been around forever. In fact, one of my old business partners back in the early days used to get an envelope every week with commodity charts and would use basically a ruler to identify patterns, and then subsequently have to call the floor trader to either to buy options on particular commodities that they were interested in participating in. So this approach has been happening forever, and it's an investor's approach to finding that edge, or to finding a set of trigger points to help them more effectively make a better decision. The shapes taken by the graphs are basically a reflection of the market's optimism or pessimism, right? So in other words, you've got prices, making higher highs and higher lows. Well, you've got the makings of an uptrend. You've got prices making lower highs and lower lows. Well, you've got the makings of a downtrend. And then subsequently, how the next price bar or candle reacts against that trend helps determine whether or not it's likely to be a continuation or the end of a particular trend. And so again, I'll just distill this back down to fear and greed. Human nature has not changed over centuries, and human reactions to similar events are likely to recur at the same rate time and time again. You're scared about the global economy, you're going to sell your securities. You think those securities have sold down low enough and that the market is now overreacting? Well, you're going to be more inclined to go back in and buy those securities. And again, this happens time and time again. And even when we look at it from the perspective of, algorithmic trading and computerized trading, although that activity takes, place on microseconds and on very short time frames, once again, recognize that all of that activity shapes up to create a trend. And, by us paying more attention to the bigger picture trend and less about the little micro movements, we'll have more confidence in being able to stay with and subsequently manage our trades more effectively. So what are some techniques? There are so many different approaches to trading, and I'm sure anybody that's online now or watching this webinar who's done any sort of background, investigating on technical analysis can attest to the fact that, everywhere you turn, there's a different technique, there's a different strategy, there's a different overlay, and everybody's trying to say, this is the right one. I will tell you once again, what it comes down to is recognizing that it's all a function of probability. And what you're trying to do is, first of all, you're trying to establish an approach that has gives you a higher probability of being accurate, with the recognition that you have some risk of being wrong, obviously, and subsequently making sure that you're using strategies, and this is where options come in, as well as money management techniques and capital allocation techniques to ensure that if you are on the wrong side of it, you're not going to blow yourself up. So techniques. Support and resistance levels are really interesting, very easy to identify, and become really important considerations, I think, more specifically for option writing. So, for example, as we'll show in some upcoming examples, the idea of being long a stock position and then looking at a price chart to say, okay, where do I want to sell calls as part of my covered call strategy that have a higher probability of expiring worthless? Well, you're going to look to a resistance level, and you're ultimately going to consider selling calls at those levels. If you're thinking about wanting to enter into a stock position or selling put options as a mechanism for generating cash flow, well, selling put options down at a support level gives you a higher probability of buying the stock at a level that it's going to find some support, as the case may be, or selling a put option that below that level that has a higher probability of expiring worthless. We want to look at trends, right? The trend is your friend. So the idea is to be able to look at a price chart, identify the start of a trend or the end of a trend, and then determine how best to position. Do I buy a call? Do I buy a put? Whatever it is that might make sense based on your directional bias at the time. And then you can also overlay some technical indicators such as volume MACD, moving averages, convergent divergence, relative momentum indicators, relative stochastics. The list goes on. And so the idea, to my mind, is that you want to find a couple of different indicators and approaches to use together. And how I tend to try to get people to think about it is, if you go back and you look at those old CSI shows, CSI Miami, whatever it is, CSI New York, it doesn't matter. If you look at the way that they process a crime scene, it's really not about finding one clue and then subsequently saying, okay, it was the gardener that did that. What they do is they build a case. And then once they have a case built, and they have the confidence that they're moving in the right direction with a high probability of being able to convict the criminal, then they're going to move forward and they're going to make the accusations. They're going to, take somebody into custody. So think about technical analysis like that. What we're looking to do is we're looking to look at a price chart. We're looking to look at some of these different indicators, apply a few different techniques, and we're looking to build a case. And if our support and resistance levels and our trend lines and our moving averages and our technical indicators all line up to suggest the high probability of moving in a movement in a certain direction, well, then we've done our due diligence and we should feel comfortable about ultimately taking a position. Now, if you add into that some underlying fundamental analysis, which might suggest that, the business is, likely to move in one direction or another because of those fundamental observations, you've just added one additional, clue, to help you identify a higher probable outcome for that underlying security, right? So again, build your case, be confident in your observations, find the right strategy and technique, and then take action. All right, support and resistance levels. Very simply put, markets never move in a straight line. And what we're looking at in terms of establishing support and resistance levels are points within the peaks and troughs of that price action that are becoming more and more common, right? So troughs are considered support levels. They're levels at which there are enough buyers to come in to push back against the selling pressure. So in other words, the price comes down to a certain level and continues to do so time and time again, and that's where the buyers come in and they start buying up the stock. So from a trader's perspective, when a share price approaches that level, this is where you may want to prepare to take action and go long. Peaks represent resistance levels. So the more times the peaks of a particular price chart trade into a certain level, the more that tells us that the investors are not prepared to take the stock any higher, right? So that can also give you cause to step back and say, okay, should I short the stock here, or do I need to take some hedging need to take hedging into consideration? But they're levels that you can step back, make an observation, and then determine how best to move forward. what ultimately ends up happening is when you get the price action crossing, above a resistance level or below a resistance level, as you'll see in this particular chart here in these examples, that is typically used as a sign of a continuation. So the way that I kind of look at it, if you think about the easier way to sort of consider this from a support level standpoint, if you're looking to short a stock, is think about, I don't know how many people online are watching this, remembers skating on ponds and going out the first of the season and trying to figure out, whether or not the ice is thick enough to support you. If you were smart, you'd let your friend Billy or Tommy go out and test that ice strength first. And only after they've been on there and demonstrated that it's going to hold up, would you go out and start enjoying the day. And so think about support levels in the same way. Ultimately, the more times it's tested and the more times it demonstrates that it's likely to hold up, the higher the probability you can get in safely and take advantage after everybody else has tested those levels. If you see this support level being tested and subsequently the price action breaks through, well, that means you probably don't want to go long, or you may want to change your directional bias and consider taking a short. Okay? So again, it's just about identifying levels where the market is testing, not being the first one. You don't have to be the first, right? And that's the other consideration too, right? You don't need to catch the absolute bottom. You don't need to catch the absolute top. We just need to catch that chunk in between, and we're going to do just fine, right? So keep that in mind again. Now, there's all sorts of techniques that you can utilize. I'm getting a little bit more sophisticated here on the mark entries, on the stall entries, where you're just using those levels as bang and it's more applied to futures trading, but or stock trading, but it's where you're using those levels to take a definitive entry point, and then you're going with it. But again, there's a significant amount of preparation and risk management that goes into that strategy as well. But those entry points are all triggered off of just the price action touching and conceivably holding those specific levels. So trend lines, markets typically move in a series of zigzags, right? And anybody that's looked at a price chart can attest to that. And what we need to recognize is, on a day-to-day basis, right, markets are going to move. I mean, and they could move in our favor and they could move against us. But by recognizing that markets don't move in a straight line, and by recognizing that there are bigger picture trend lines and support levels in place, once you get into a trade, you can use these observations to help stay with the trade regardless of what's happening on the shorter time frames. So even if the algos are wreaking havoc intraday, with short-term swings and you're getting, a couple of points up and a couple of points down, provided that your technical levels are holding, then you can use that as a discipline to stay with the trade. And discipline is really important, right? Your technical observations can help you establish a discipline which will allow you to be patient for trade entry, be patient for trade exit, and be patient for simply just stepping back and staying out of the market if your observations suggest that makes sense. As most of you know, I'm sure by now, market trends can be labeled in one of three ways: bullish, bearish, or neutral. And the cool thing about the options market is we have strategies that will allow us to participate in all three. We've got bullish strategies where we buy calls, we sell puts, we do spread strategies. We got bearish strategies where we buy puts, we sell calls, we do spreads. We've got neutral strategies where we can do iron condors, or we can do credit spreads, or we can do put writing or call writing, above or below specific ranges in order to participate. So, gauging the personality of a stock, gauging the trend that's in place will ultimately help you make the best decision possible in terms of strategy selection as well. An old saying that I've heard, and again, I'm throwing these sort of old cliches or anecdotes out there as food for thought. But, one old strategy or one old saying that I read that I think makes a lot of sense is that a market technician can trade without the fundamentals, but a fundamentalist can't trade without the technicals. And that basically just ties back into that observation that no matter what your research and analysis suggests, price action discounts everything, and it really is important to make sure you're building that into your decision-making process. Moving averages are really simple. In fact, there are simple moving averages that you can apply. But really what this technique does is it just takes a certain time frame and averages out the price action within that time frame and plots a line. And the idea is as long as the price action is above that particular moving average, well, you're in an uptrend. And if the price action is below that particular moving average, well, you're in a downtrend. And so for those of you that don't really want to get, all that deep into technical analysis, even just overlaying a moving average on a price chart can really help you make some important decisions as to whether or not it's a good time to get into the trade, whether or not it's a good time to get out of the trade, or whether it makes sense to, sell call options or maybe buy puts for protection. So the simple moving average, typically available through any charting software that you can access within your brokerage platform, really works well. The most frequently used are 10 days, which is basically 2 weeks, 20 days, 4 weeks, 50 days, 10 weeks, and 200 days, 40 weeks, which really gives you that bigger picture trend line, right? The other approach is you can use a moving average crossover. So for sort of shorter term trading decisions, you can use an 8-day or an 8-bar and a 21-bar. And when the short term crosses above the longer term, buy signal. When the short term crosses below, sell signal. And, again, we're not talking about this being accurate all the time, but it gives you some tools that can help you, help you be disciplined with your entry and exits, right? It gives you that trigger that says, okay, I should take action because this is what's happening now. Now, indicators are really an interesting tool to be used as well, because everything up until this point we've been talking about applying to the actual price chart itself, right? So we're looking at trend lines, we're looking at moving averages, we're looking at support resistance levels. Indicators, or what are often referred to as lower indicators, and they're referred to as lower indicators because they're added below your price chart, basically take a number of different details from the price action and then subsequently creates what's known as an oscillator that can provide signals as well, supportive signals to a directional bias. They can be used to measure the speed and strength of such movements. I really like the idea of being able to identify overbought or oversold ranges within a price chart, because I think that, just as that last bullet point suggests, it helps us identify when a trend is running out of steam or possibly reversing. And again, a kind of analogy that I use for this, particularly when trying to identify when an uptrend is running out of steam, is think about when we throw a ball up in the air. Now, if we only looked at one characteristic of that, or if we only made one observation and that was, hey, the ball is going higher, then we would just make the assumption that that ball is going to keep going forever. As long as it's going up, it's going up. And there's nothing to tell us otherwise. However, if we apply gravity and our understanding of gravity and momentum to that, we realize that even though that ball is going higher, gravity is exerting a force on it, and it's slowing its momentum down to the point that inevitably, once that momentum stops and once gravity takes its full effect, it's going to turn around and come back down. So these momentum indicators become a pretty cool way to sort of apply that same philosophy, that same mindset. even though we see the price action going higher, ultimately, if we can identify the strength of that move, and if we can see that that move is actually losing steam, we might be more inclined to, again, number one, take profits. Number two, maybe overlay a call writing strategy, because now we see that, the momentum is slowing and we're not necessarily going to cap our upside. We may want to decide to buy a put for protection, or we may just want to sit back and say, okay, observation one, this trend is losing steam. Observation two, if it breaks below the trend line, I'm shorting, right? So now you're starting to build that case. I'm buying put options or whatever, to participate. So a couple of indicators that you'll see very common, relative strength index, RSI. We don't need to get into the mathematics of it, but basically what it does is it measures the relative strength of a movement in a particular price action. The rationale behind this is quite simple. When there is strength in the price movement, the scope of the movement on a day-to-day basis, for example, is going to be strong. So in other words, everybody wants to buy the stock, so you might see the stock go up 50 cents a day, 60 cents a day, 80 cents a day, as demand is flooding into the market and investors are prepared to pay more. Now, when that demand starts to dissipate, what you see happening is, the stock may be moving higher, but ultimately what's happening is instead of it going up 80 cents a day, it's only going 70. Oh, now it's only going 60. Oh, now it's only going 40. Oh, now it's only going 10, right? So again, from a technical standpoint, based on the price of the stock, hey, it's going higher, nothing to worry about. But the scope of that price action on a day-to-day basis is now starting to tighten up, and that is a clue to suggest that it's losing momentum. And that's really what the RSI does. There's also the stochastics indicator. They're both momentum indicators. Very, very interesting. Now, what I would caution, there's a really, again, I read this a while back. There's a term that's referred to as multicollinearity, and I love throwing it out there because it just, it just makes you sound smart. Really what it means is you're using multiple indicators that are all derived from the exact same information. And that doesn't do anybody any good. Oftentimes we'll see in the movies or on TV, you'll see screens with lines and graphs and indicators and oscillators. But think about it, really at the end of the day, there's only so much information that can be calculated and derived from a price chart. Volume, price action, and duration and time. Beyond that, there's not much more. So really, we need to be able to focus on a couple of different indicators that are telling us different things. So, for example, a break of a resistance level on increased volume. Well, wait a second. We've got the resistance level broken. The market feels that the stock's worth more, and there's more volume supporting that move. Again, lends itself to a higher probability of being correct. MACD, moving average convergence divergence, really interesting technical indicator. Again, it's added to the bottom of the chart. We do have a couple of examples here, so why don't I just transition to the next slide here for you guys to see. Relative strength index, as you can see here, very interesting. Every time that particular indicator was within what we would refer to as the overbought territory, you'll notice that historically that stock has sold off. Every time it was down in the lower range, which we would call oversold, you'll recognize that historically the stock has rallied or bumped or jumped higher. Now, there's no guarantee as to the extent of the move that is going to follow that particular observation. But once you've made that observation, you could then use the other techniques to help you enter and then subsequently stay with the trade, right? So there's your relative strength index, which is a pretty cool technical indicator to add as a complement to, trend line analysis or moving average analysis or any of these other, price-based approaches that we've already been discussing, right? MACD is really interesting as well. I like this because it also really, it's referred to as moving average convergence and divergence. And the way that you would apply this is, let's say, for example, we have, and hopefully you can see my cursor here. Let's say we've got a price action taking place, and we've got a high, and then we have another high and another high. And if we connected those peaks, we would be able to identify an uptrend, right? Lower high, higher high, uptrend. However, what the MACD helps us identify very quickly is on this peak, our MACD was up here at the 0.50. On this peak, we can see that it's actually lower. So it's another way to really help us identify when a move is potentially coming to an end, and a change in trend is actually a higher probability. The convergence divergence is exactly that. If you've got divergence taking place, you've got higher highs being made on the chart, you've got lower highs being made on the MACD. Divergence is the other way around. You've got lower highs being made on the chart, and you've got higher highs being made on the MACD. A great example might be somewhere down where right down in here where you've sort of got these lows coming in, but you've got the MACD moving higher here, demonstrating some some convergence in that case. Divergence when they're obviously moving away from each other, convergence when they're coming together. Now, the other consideration here too is that the width between the two lines here also helps identify strength and trend. The wider those two lines are, the more the short-term trend is running away from the longer-term trend, indicating strength. As those lines come together, it's showing that the short-term trend is starting to come back into the longer-term trend, and if it crosses below, there's your trade signal. Okay, so again, you guys can kind of step away and digest some of these different examples and some of these different indicators and oscillators and decide which might make sense to you, but just don't make the mistake of trying to use everything. It's analysis paralysis, and you'll end up just one indicator will say this, another indicator will say that, and you'll be frozen. So remember, pick a couple that make sense and focus on getting good at identifying and executing based on those. All right, so taking a position. We've got all sorts of option strategies available to us, right? And, this, at the end of the day, we've gone through bullish strategies and bearish strategies and defensive strategies that we can consider based on our expectation as to what the underlying stock's going to do. What we haven't done in the past up until now is helping sort of create an approach to identify, all right, well, when would I use that strategy? What's my signal to get in? What's my signal to get out? What's my signal to hedge? How do I know if the stock is actually trending sideways? What are my sort of observations that are going to help me determine if I should use a neutral strategy or not? So this is where your technical observations can tie into your strategy selection and execution. So we've gone, and for the sake of the time that we have left here, I mean, we've outlined several strategies within this presentation that one could consider, and tied together with them what's called the risk-reward profile, which helps you identify the risk exposure of a particular security. So, to keep it simple, if we're bullish on a stock, most of you are already aware that we can buy a call option as a stock replacement strategy. So we would use technical analysis to identify the directional bias, and then we would subsequently use the option strategy instead of the underlying stock to participate. right? We understand, and again, if you're not sure about the strategy, please go back to our, one of our earlier webinars to reinforce it. But really, the opportunity in buying a call option or buying an option in general, whether it's call or put, is we have a limited amount of capital that we need to put up with a defined risk. Okay? And again, we have a defined time frame, which means the more strategic we can be about timing our entry, the more effective we'll be at taking advantage of the amount of time that we have available within the life cycle of that option contract. You've got selling put options. Again, something we've talked about from an income generating standpoint. Unidentifiable risk exposure, limited potential by way of the credit that we've received. But again, a strategy that if we're looking at a stock bouncing off of a support level, we may want to implement. Defensive strategies, buying a put option. You see a stock hitting a resistance level, or the stock actually is reversing off of a resistance level and breaks a longer term or even shorter term trend line. Your trigger may very well to be buy a protected put, right? So in this example, long-term trend line that you've observed in the price chart says up, short-term trend line that you're observing says down. Hold the stock for the long term because you like it. It's fundamentally sound. It's a rock-solid business. But then subsequently integrate that put option as a hedging strategy based on the short-term risks and observations that you're seeing within the price chart. Selling covered calls. Again, great income generating strategy, but it's also a strategy that can help you reduce the cost basis. So as shares are trading into a resistance level, you can use the resistance level average price range as the range at which you want to be selling calls above, with a higher probability of having them expire worthless, right? And again, with that strategy, you're limiting your upside potential on the stock. You're limiting the amount of cash flow you're generating by the premium from the call that you've collected, and you have an unidentified risk exposure by way of the underlying stock. But if you're bullish the stock, this strategy becomes defensive, right? If you were bearish the stock and worried about the downside based on what you're seeing in the price chart, you would go back and you would integrate a hedging strategy, or you would do a combination. You would sell the call at the resistance level, you'd buy a put at the support level, and you've created what's known as a collar strategy around your stock. All of this being built out of your observations, the observations that you're gleaning from the price chart. Bearish strategies, again, we touched on the idea of buying put options. The idea is that we want to take advantage of a drop in the share value. We don't want to short the stock, or we can't short the stock because we're looking at this in a TFSA or an RSP, but we can buy a put option. So all of our technical observations apply. We identify a resistance level, a reversal, a break of a trend line. Maybe the stock, the underlying lower indicator says overbought. You're going to go to the options market and buy a put option to participate. And again, you can sell call options as a bearish strategy as well. Again, taking advantage of the price decline in the stock. And as the stock price declines, the value of the call option contract declines. You ultimately benefit from keeping the premium that you've put out there. So in tying this all together in a little bit of an example here, let's take a look at this price chart. Again, a lot of stuff happening here. But let's look at the moving averages, for example, and what we're sort of seeing here as a signal. So you can see, that as certain observations are being made on this price chart, you're seeing certain signals, being put forward to help us decide what strategy makes sense. So when you've got moving this is an example of a moving average crossover. Let's just take more specifically this example here when the shares were at 21.21. You've got this crossover of a moving average indicating the likelihood of a downtrend. You could also go back to a previous support level, and as share values drop below that, that also signals the trade to the downside. You can also then tie that together with what's happening with your underlying oscillator here, indicating that it's sort of peaking out at these levels as well, suggesting that it's overbought. And so all of this information comes together to say, let's go short, or let's do some sort of a strategy to capitalize on the stock selling off. Flip it, and you can see the exact same application at the reversal point down here, right? Where at this point, you can see that your RSI is starting to build strength to the upside after being oversold. You can see that your shorter term moving average here is crossing over your longer term. You've got to break above what we would call a pivot point, a previous resistance. And now you have that uptrend in place. And so the process continues, right? And I don't want to oversimplify this, guys. I wish it was just as easy as, oh, we crossed, let's go, let's make a fortune. Oh, we crossed back, okay, let's get out. It's not that easy, but the more you can put in place as far as your vetting process is concerned, as far as your due diligence, the higher the probability there is at you being right about the position that you're taking. And it's also a way that you can, just to kind of build on that, you can actually, use technical analysis to help you decide to add to a position. So in other words, you buy calls when the moving average crosses over. Okay, so you buy 3 calls. And you get a nice little run, and it pulls back, but all your technical indicators says, hey, you're still going higher. You get another push forward. It breaks a previous high. Maybe buy a few more calls, right? And so on and so forth. So you can use technicals to help build a position as well by looking at some of these trigger points and just taking action when certain criteria is being met. All right, so let's look at the sell signal logistics here. So, we saw a sell signal on the chart on July 10th, XIU's at 21.21. You can sell or write an at-the-money call option and collect $1.25. The reason why you're doing that is you're thinking, okay, my technicals are suggesting that the stocks, or in this case, the ETF is not going any higher. It's hitting a resistance level. It's overbought. Let's sell and collect the premium. All right. Now you're right. The stock rejects off of the resistance level. The moving average is crossed down and the stock starts to drop. You can see that if we go back to that price chart here very, very quickly, there's your entry point at 21.21, and there is down here on May 9th. Now this is a longer time frame here. Shares are starting to turn around and go up, and you're starting to see them turn bullish. Well, basically, that's your signal to get out. Okay, you buy that call option back when the shares are at 19.94. You don't wait for those shares to go back up to 20.21. At that point, you can buy those calls back for 5 cents. Your profit is $1.20 per contract, right? So all you've done is you've used technical analysis to get in. That was your signal to sell the call. You used technical analysis to get out. That was your signal to buy to cover to get out before the shares trended any higher and that call option value increased and you had to buy it back more expensive. All right, another example here, just buying simply a call option on May 9th here. Shares are breaking above that resistance level, pushing above the moving averages. You're going to buy the in-the-money call at $4.25. And again, technically, the shares now on March 17th are suggesting that you're hitting a resistance level. They've jumped to $22.92. You're going to sell the call option that you bought a while back based on the signals that you're observing, and where once you paid in $4.25, because you caught a portion of that trend, remember, not necessarily all of it, you can sell at $6.92, profit of $2.67, and ultimately, you've made a fairly healthy return on your investment. Again, just simply using technical analysis to help you gauge your entry points. All right. So ultimately what we're looking at here is you've used technical analysis in both example 1 and example 2 to make an unbiased decision, right? Technicals are telling me this, I'm going to go short, and I'm going to stay with the trade until technicals tell me otherwise. Technicals then suggest a change in trend. You close that short position, you subsequently go long, and then you hold that position again until the technicals tell you otherwise. So you've now participated in that one underlying security, in this case the XIE, the ETF, completely unbiased from what's happening other than what's the price action telling you? Is it going lower or is it going higher? And what signals am I going to use to take action? So this is where you've gone bullish and you've gone bearish to start. You've flipped and turned bullish. No hemming and hawing. Here's your strategy. Here's your approach. Here's your signal. Let's go and let's take action. And in this case, you were bullish and bearish, and in both cases, you were able to generate a return. All right, here's your RSI indicator. Again, just a quick example of just simply using this as a decision to take action. You can see in every case here where your RSI indicator, your relative strength indicator, has been overbought or oversold. By overbought, I mean way up in the upper range here between 80 and 100. By oversold, I mean down below that 40 level, down towards your 0 and 20 range. Those are telling you when the markets are at extremes and where you may want to take action. So during overbought conditions, buy protective puts or buy puts to take a bearish stance, or write covered or uncovered call options. When you're in that oversold, buy call options or sell put options to capitalize on, the oversold conditions and the likelihood of the stock actually turning and moving higher from there. All right, selecting the right options. There's really two issues to consider here: which strikes to choose and which expiration date to choose. And that is a primary consideration no matter what you're using to enter into your investments. Out of the money options, you're going to pay a smaller premium with the opportunity to, really reap some really good returns if the move in the stock happens in a short period of time. On the other side of it, in the money options, you're going to pay more. You can obviously generate a pretty good return or a good return, but from a percentage rate of return standpoint, obviously the less you pay originally, the higher the rate of return if you're right about the market move. There's all sorts of reasons why you might choose an out of the money versus an in the money. I always think, and again, not a recommendation, but an at the money option gives you the best of both worlds. You're trading a strike price that is currently where the stock price is trading. If you're right, the move's going to happen, and the move starts to take place, and ideally quickly. The delta of your at the money option is going to increase. You're going to start capturing return very quickly, and it's also going to slow down the rate of time depreciation. If you're wrong and the stock goes against you, well, you haven't put up a significant amount of capital, unlike if you bought the in the money option with a lot of intrinsic value. So you kind of get the best of both worlds. Again, up to you to make that determination based on reviewing our previous educational sessions and some of the considerations that we put forward. But again, that happy medium, that strike price that's at the money, once you see that breakout taking place, if you're going to go long the option as a directional bias, that at the money tends to work. Whether if you're option writing, for example, again, the further out you go, the less premium you're going to collect, but the higher the probability is going to expire worthless. So again, it's all about what you're trying to accomplish with the position. As far as time depreciation, choosing the expiry date, it's really the same consideration. Short-term options, you pay less in time value. You want to make darn sure you're confident that that stock is going to make a move very quickly. This is where your technical analysis comes into play in terms of just taking action strategically. That being said, longer-term options give you more time to, weather those ups and downs, but the challenge is you're going to pay more. Again, general rule of thumb that I like to consider is, if you are a shorter-term trader using technicals, give yourself 2 to 3 months. you can always get out tomorrow. You can always get out next week. But if the stock starts to chop about, if you're trading a directional bias, having that extra month or so is going to give you some staying power, right? So you want to find that happy medium between going way out in the expiration cycle and paying a huge premium and staying within a time frame that makes sense, paying less premium, lowering your risk exposure, but still giving yourself enough time to participate. Again, it's going to be up to you to determine what makes sense for you based on your objectives. That's where a trade plan always makes a lot of sense. But again, as the option buyer trading a directional bias, I tend to think at the money 2 to 3 months out makes sense. If you're the option writer, remember, when you're selling premium, the faster that it expires, the quicker you keep the premium. So oftentimes, the option writer is not looking to sell a way out of the money option contract. They're typically looking to sell the shorter term option contracts either at the money or slightly out of the money or above a resistance level so that they can capture that time depreciation component, which is how we make money as the option writer. So with that in mind, everybody, just a friendly reminder that you can't predict the future. We don't have a crystal ball. Even with technical analysis, you're dealing in probabilities. Really what we're looking to identify is a number of different observations within a price chart to lend credibility to a specific directional bias where in the past those observations have preceded a particular move. From there, we're going to go to the options market to find how best to participate depending upon what we're looking to accomplish. And at the end of the day, because we put those probabilities in our favor, ideally we have a higher probability of being right and generating return off of the opportunity that we're looking to participate in. Remember that a technician analyzes the market to identify a directional bias in which the price action is moving. The technical analysis will seek to take a position by following the trend. Now, whether that's looking for a trend reversal or whether it's looking for a continuation pattern to support, entering in a pause in the prevailing trend. But at the end of the day, you're looking at the price action in order to take action on your trade. And at the end of it all, and once again, each position has the potential to succeed or fail. We still run the risk of losing, so we always want to make sure that we're focused on capital allocation, capital management, how much are we risking before we actually click the trade button, because even though we've done all of our due diligence and even though we've looked at the technical 6 ways to Sunday, there's always that chance that we could be wrong, and we want to make sure we're managing for it. So with that in mind, folks, remember that there's a great little tool that you can use on the Montreal Exchange site called Options Play. It actually takes into consideration some of the technical observations that we've talked about here, creates a score, and then looks to the option market to suggest some interesting option strategies that might work. Beyond that, of course, there is the trading simulator in which you can actually test drive some of these strategies and some of these approaches before you trade your real money so that you get a feel for what positions look like in the market, before you actually go ahead and commit your live capital. Remember, as always, everybody, lots of information available on the Montreal Exchange site between blogs, videos, and webinars. And of course, as Charles mentioned in the beginning, lots of information, lots of videos archived for you to go back and look at. I am a product of the repetition and reinforcement process, which means the only way I got to know what I know now, and I'm still learning, is just by reviewing and repeating and going back and looking at videos and reading as much as I can. So keep that in mind, guys. The learning curve may seem steep, but it gets easier and easier the more you commit to it and the more time you spend with us in these sessions and, of course, reviewing the recordings.